Welcome investors to the 40 Finance channel. My name's Jeff Beers. Today we're going to look at 5 value stocks that still have growth upside to them and the chance for you to make some money over the next 12 months or so. Now with these value stocks, you got to get out of the mindset of the Teslas and the Nvidias and all those people who are jumping, 20, 30, 50% in a single year. The game with stocks like these is much different. It's a little bit of a safer play, but you do have upside potential. Most of them have dividends, and quite frankly, if you're holding on to cash, these are the types of stocks that are not going to have the same volatility as you would get with the Tesla, but they're going to pay off much better than just holding cash in your mattress or in a shoebox somewhere. Reminder as always that my stock picks and projections are just my opinion for your entertainment. Please talk to a financial professional before taking on the risks of investing. But if you enjoy stock market analysis and going deep on stocks like these, then please subscribe to the 40 Finance channel. I publish 3 or 4 videos every single week, so make sure you sign up to keep track of all the latest videos. And if you're interested in joining my email list, I got a free bonus for you, my 15-minute stock analysis guide. Great tips in there for you to do quick, thoughtful analysis on the ticker symbols you see in social media and on TV. This guide will help you build a better watch list and give you a much better feel for which way a stock could trend in the future, given all the free resources I've included to help you do better research. Before we kick off today, let's get some quick selection criteria for this list of 5 value stocks. Pretty simple. We're looking for PEs that are under 20. We're looking at projected EPS growth over the next 2 years. We also want to see some analyst price upside, which helps us get some outside views on which way the stock is trending. And finally, we do want to control our risk a little bit here. Make sure that these are not companies we think will go bankrupt or run out of money. So all that stuff comes into play. All right, first stock on the board today is eBay, currently trading at $53.14. With eBay, you see in the yellow boxes, you have a P ratio of 823, so even under 10 in this range. You got a EPS over the trailing 12 months, so that's a mix across different fiscal years. And eBay does include a dividend currently at 1.22%. When you look off to the 1-year chart on the right, you can see how eBay's been performing. Pretty stagnant up through the pandemic, but as a lot of companies have seen in the online space, shortly after the stay-at-home orders, eBay saw a significant uptick in their business, currently sitting right now at $53. And the interesting thing about eBay is the opportunity to get a piece of a digital internet marketplace here in value territory. So if we go up to the top where I've put a few notes, you can see that first line of EPS, and LY stands for last year, then we got this year, and NY is for next year. So you look at that EPS LY of 283, then you go to TY this year at 358, and next year at 396. So solid EPS projections. Obviously, going through this presentation as we have this year and the next year numbers are going to be estimates. So just keep that in mind. Those are estimates as of now. Looking at trailing 12 months revenue for this company, $11 billion, which is obviously a great number. Cash on hand of $5 billion and a debt load of $9 billion. So with debt, we always consider how much is owed. Do you have the resources to pay it? And we keep in mind that paying off debt is a long-term game. So in this case, with $5 billion, I feel pretty comfortable where eBay sits, maybe a little high, but don't forget their trailing 12 months revenue coming in at $11 billion and profits are growing, so I think it's all manageable. All right, so let's take a look at what the analysts think of eBay projecting out over the next 12 months. And the most important thing with analyst recommendations and ratings is you want to make sure that you have sort of fresh updates. So eBay's only had one, if you go off to the far right, you can see the date column. eBay's only had one that's newer than 1 month, and that is a buy at $65, which is 23% up from where we are today. But if you go down the column, you can see most analysts agree price upside is definitely there, anywhere in the range from the single digits all the way through into even the 30s and 50% for a couple of these guys. All right, next up we have CVS Health Corporation, CVS, which I think everyone has one of those in their town, fierce competitor of Walgreens, but they have also expanded into several additional health offerings. They of course merged with Aetna Health Insurance, so now they have a connected line into insurance, and they have also begun to offer clinics within some of their stores. Looking at the stock today, price of $57.84. You've got another PE ratio under 10 here at 9.19. You got an EPS in the trailing 12 months of $6.29 and a forward dividend of 3.48% as of today. You look at the stock chart off to the right, you can see that the pandemic hasn't necessarily been super friendly to CVS from a stock price appreciation perspective. You obviously had some store closures in there. There's also a fact in there that a lot of people have put off doctor visits. They have also passed on some medical procedures. So a lot of the new equipment and new medical sales that you would have seen this year were kind of on pause for the majority of consumers. Looking at the top of the board at my EPS line, last year you were at 708. This year's projected at 723, and next year gets to 753. So not huge growth there, but it is trending in the right direction. And there is this point that some folks buy into that CVS will reach sort of an efficiency play with the Aetna Health Insurance and the clinical offerings that they can do in local locations. So that's kind of the game here. You have trailing 12 months revenue of $263 billion, which is a monster number. You have $17.5 billion in cash, and the debt load right now of $92 billion. Definitely a little bit higher debt than we would probably care to see, but I can tell you, just knowing CVS, that debt level has actually come down significantly. They were much higher during the initial phase of the Aetna acquisition. I haven't studied how they've been managing that debt, but my guess is that they have a plan to bring it down even further now that the merger has taken place. All right, looking at the analyst ratings, most of them are about a month old, which isn't too bad. I wish there was a fresher one on there, but you can see the bottom line here is that you pretty much have buys across the board, and you have price upsides in the 80s, 90s, and even a 104. That's anywhere from 40% to 80% upside projected over the next 12 months. All right, next stock on the board is Applied Materials, and Applied Materials makes manufacturing parts and supplies for the semiconductor industry. So when you think about all the NVIDIAs and Intels and AMDs, those pieces and parts have to be manufactured, and Applied Materials helps provide the equipment for those companies to actually build their chips. And Applied Materials has major contracts with a lot of the household chip names that you're familiar with. Looking at the stock price today, we're at $56.45. Current PE ratio of 16.42. Trailing 12 months EPS is 3.44. And here's another one that offers a small dividend, 1.6% on today's price. Looking at the stock chart off to the right, you've got relatively flat performance over the past 12 months. No surprise on the dip around March. Then they've crawled their way back, but they're actually bouncing back from a little bit of a recent dip. So there's definitely an opportunity here if you are bullish on the semiconductor industry over the next couple years. Looking high at the top at the EPS line, last year they did 304. This year's projected at 406. And next year's projected at 459. So good growth numbers there on the EPS lines. You got trailing 12 months revenue of $16.2 billion. cash on hand of $4.7 billion, and the debt load is $5.7 billion. So definitely manageable across the board there. All right, taking a look at our analyst ratings, we have mostly buys. All of these coming in about a month ago. The top line is only 17 days old. And you see what we have here is a general consensus of, 25 to 45% essentially across the board. So analysts are bullish on this one. And I think as a long-term play, semiconductors seemingly have become such a big part of our life. I don't see that going away anytime soon. So this is a chance to get in on a value stock that has relatively significant upside, even in the short term. All right, next on the board is LKQ Corporation. This is a monster player in the auto parts industry, both from a reconditioned auto parts play, and then also like sort of the OEM compatible auto parts segment. Basically making third party and reconditioned parts for the auto industry. And the play here, especially as money gets tighter for a lot of folks, is the investment in your current vehicle as opposed to running out and buying a new one. So I think there's a lot of opportunity on this one, and it's a stock that's been on my watch list for a little while now. All right, stock price today of $32.21. We got a PE ratio of 17.71. Trailing 12 months EPS of 1.82. This is one here that does not offer a dividend. However, if you look off to the stock chart on the right, you can see that it was flying pretty well above 30 consistently. And then, of course, with the lockdown, we had a major dip. I would imagine that the demand for auto parts shrank significantly. However, you're seeing things tick back up to the top here. And if you go to the EPS line at the top, last year was 237. This year takes a step back, 2.09. However, you look ahead to next year, which I put LY there, but it should be NY. Next year goes to 250. And then after that, I think you start to see this market return to normal. So this could be an opportunity on one that you're not necessarily buying super low, but it's a solid company with a great track record. And I think you're just waiting for auto part needs to resume. And then you have to think about, do you have a bullish bet that deferred maintenance will come back into play as people get out more, and the rush for these types of auto parts will pick up. Trailing 12 months revenue of $11.7 billion. Little light on cash at around $500 million, and the debt is in at $4.6 billion. I'm guessing on cash with closures and whatnot, they had to spend more cash than they were likely super excited to do. Hopefully that level will rise up, but something to keep an eye on there for sure. All right, taking a look at our analysts, this particular stock has relatively fresh ratings. If you look to the far right, you can see 2 days ago we got new picks come in, and you've got buys across the board with an upside between 18% and 49%. So analysts in general do see some returns for stockholders over the next 12 months. All right, number 5 in our last stock on the board is JPMorgan. And it's hard to actually believe that this is kind of a value stock, but the financial sector, while there's been a lot of whispers about it bouncing back, it just hasn't done that yet. And JPMorgan always sits in the middle of a bull versus bear kind of fight between analysts on, how much further can it go and yada, yada, yada. So you'll have to make your own decisions here. But I think regardless with JPM, no one's going to argue a 3 to 5 year play on a stock like this. Okay, so stock price today at 103.23. You got a P ratio of 1382. Keep in mind that financial and bank stocks typically have lower PEs, so that 1382 compared to like a Microsoft or an Nvidia, they're not really apples to apples, so just keep that in mind. Trailing 12 months EPS of 747, and you get a nice dividend with this one, 3.56% of today's price. And you see off to the right on the stock chart, a lot of uncertainty with the pandemic and lockdown really took a bite out of JPMorgan stock. However, I think one of the things we know intrinsically is that there's been a lot of investment in the stock space, and I think that the appetite for investing, particularly as interest rates are lower, while that does work against JPMorgan when interest rates are lower, they probably also have a great opportunity to add to their client base and engage old accounts perhaps who haven't made many changes lately. Going up to the top to the EPS line, you got last year at 1072. This year did take a dip so far. It's projected to land at 575, and then next year starts to return a little bit back to normal at 882. This is definitely a buy lower. However, JPMorgan does a lot with investing, so they potentially have the opportunity to find other ways to make money to make up for the interest rate cuts. Trailing 12 months revenue of $97 billion. Cash on hand of $1.25 trillion. Don't forget that with banks, cash on hand works a little bit differently because you're holding assets of other people, but 1.25 trillion, that's a great number. You do have $690 billion in debt, so that's something that you do have to pay attention to and make sure that assets and liabilities stay stable. Okay, on the analyst side of the coin, going off to the far right, we do have a couple analysts that have come in recently. There's some that are 2 months old that I kind of throw out, to be honest with you, because the game's changing so fast in the market right now. But you got two buys, price target of 115 and 122. So that's anywhere from 10 to 20% upside projected over the next 12 months. You factor in a solid dividend, and there is definitely potential here to make some decent money over the next year plus. All right, investors, that's 5 value stocks with strong upside. Each one has their own individual story, but we're trying to look for value opportunities right now in the stock market. It kind of looked like things were going to dip a little bit, coming into Labor Day and shortly after. We saw some red days, so to speak. But, I was back on the computer again before recording this, and stocks, look like they were bumping up another 1 or 2% today. So when you're in this environment, if you don't feel comfortable about those high PE growth stocks, the traditional ones, I think there's a lot of opportunity in the 5 names here to grow your money, perhaps at a slower rate, but at a safer rate, and in most cases with a dividend. Hope you guys enjoyed this video. Please give me a like and subscribe if you did. I'll see you on the next video.